So in today's session, we're looking at ways that we can finance a non-current asset. And as you can see in this diagram, there's potentially four ways. We can buy the asset outright. We could use a finance lease to finance the asset, a hire purchase to finance the asset, or a chattel mortgage to finance the asset. Now today, we're going to be focusing on buying the asset outright and a chattel mortgage. Now clearly a way to purchase an asset is to purchase the asset with cash. In other words, you're using the cash reserves of the business. This will not involve any borrowings. The advantage of the option is that the entity is not required to borrow money from a bank or from a financial institution. So the good thing here, we will save on the costs of borrowing. Things like loan fees, interest charges. We won't have to pay them and the business will be more profitable. There is also less risk to the business when we do not borrow money. The disadvantage is that the entity or business is using its cash reserves that it might use for something else useful in the business. So what's the journal entry? Let's say our business has purchased $33,000 worth of equipment and the business is registered for GST. The journal entry, plant and equipment debit $30,000, GST receivable debit $3,000, and cash credit $33,000, which means we're taking $33,000 out of the bank account. So what have we just done? The entity has recorded the cost of the equipment in the balance sheet at its GST exclusive cost. All non-current assets will be depreciated over the estimated useful life in accordance with AASB 116. Therefore, the entity will calculate and record the depreciation expense in the profit and loss and credit a contra account called accumulated depreciation in the balance sheet. Remember, there's no interest expense and there's no borrowing costs as well. So what are the tax consequences? The equipment is considered a depreciable asset and subject to the depreciation rules in accordance with Division 40 of the legislation. The depreciation will vary depending on the type of taxpayer. And we discuss that in Chapter 11 of the Australian Master Bookkeepers Guide. Generally, an asset is depreciated over its effective life at the rate set out by the Commissioner. And we have a link in the description below. Now for GST, an input tax credit can be claimed when the invoice is received if you're on the accruals basis. If you're on the cash basis, an input tax credit can be claimed or the GST can be claimed when the payment to acquire the asset is made. Moving on to our second method of financing a non-current asset, and in this case it's a chattel mortgage. A chattel mortgage is an arrangement where the purchaser of goods, including a car, borrows money from the lender to finance the acquisition or the purchase. In exchange, the lender, maybe a bank, will take security over the goods being financed in the event of default by the purchaser. With this method, the entity takes immediate ownership of the asset from the beginning of the loan. The title of the goods passes to the purchaser immediately. In terms of income tax, depreciation will vary. Please review Chapter 11 of the book. Generally, an asset will be depreciated over its effective life at the rate set out by the Commissioner. Now in terms of GST, something a little different. Regardless of the entity being on the cash basis or accruals basis for GST, the entity is entitled to claim the GST back with the purchase of the asset in the tax period in which the borrowed funds have been applied to acquire the asset. In other words, when we purchase the asset. So generally we'll sign the paperwork on the loan and we will receive a tax invoice for the cost of the equipment. You can see the journal entry in this slide. What happens when you make a payment? The entity in our example makes monthly chattel mortgage payments of $990 on the 26th day of each calendar month. Now for the first payment on the 26th, the bookkeeper records the following journal: chattel mortgage expense repayments debit, cash at bank credit. So from an accounting perspective, each monthly chattel mortgage payment must be apportioned between the interest expense and the reduction in the chattel mortgage liability. The interest expense component is calculated using a loan schedule. This chattel mortgage schedule will show the interest expense over the term of the loan and the reduction in the liability for each payment. We have a full example in Chapter 7 of the textbook. Your accountant will normally prepare this schedule, but we'll have a video on this subject very soon. So our journal entry: chattel mortgage expense repayments debit $990, cash at bank $990 for each repayment. Once the accountant provides the chattel mortgage schedule, you can then allocate the monthly payments. We have an example here: interest expense debit $265 for the interest component, chattel mortgage liability debit $725, and we will reverse the $990 from the temporary chattel mortgage expense repayments account. It is not uncommon to see a final lump sum payment, and this is sometimes called a balloon payment. If there is a balloon payment in your chattel mortgage, the journal entry is here. Once again, if you would like to see the full example, including the chattel mortgage schedule, please refer to Chapter 7 of the Australian Master Bookkeepers Guide.